An acronym which you may have heard before is that real estate becomes the ideal investment. So let's look at that one by one. I means you can get income. Real estate will produce income, and if income minus expenses, minus your mortgage, etc., yields you some money every month, then having a bunch of rental properties will produce you more money. Now, I have to warn you, though, it could go negative. You know, it's not like investing in the stock market where if you lose money, you just lose your investment. In real estate, you can put up an investment and then have to put up more money to feed the alligator, so to speak. So be careful to make sure that you have enough reserves when you invest in rental properties in case you have a bad month. D is depreciation. Now, you may think that that's a bad thing, but that's actually a tax write-off. Because real estate is divided up between the structure and the land. And for tax purposes, the structure depreciates. You depreciate it or get a tax write-off on it every year for its useful life. So I'm going to make it, even though it's not this number, I'm going to make it easy for the math to say, let's say you depreciated the house over 10 years, and it was a $100,000 house, and let's say half of the value was land, and half of the value was the structure. You get $50,000 depreciation over 10 years, would be approximately $5,000 a year tax write-off. It doesn't actually come out to that, but I wanted to use simple math so you follow the example. So if you had positive income, let's say, of $2,000 a year, you would actually have a loss on paper of $3,000 a year. So you're actually earning money and you're getting a loss that you can use to offset other income, let's say, for example, in another business or job. So great tax write-off for having rental properties. E is equity. As the property pays down on the mortgage, you're building equity in the property. Or if you do repairs or improvements, you're improving your equity position and your net worth. Also, appreciation. Now, in the short term, it may go down or up or sideways, but in the long run, 10 or 20 years, real estate values, almost without exception, are going to go up net in the long run. And if you doubt that, how would you like to buy the house you grew up in, your parents' house, for the price they paid for it now? Duh, of course. And then, of course, leverage, as we talked about earlier, the 4-house example versus the 1-house example. Being able to buy a large asset or number of assets with a small amount of money.